This is a carrying spotlight where markets meet carity and institutional navigate liquidity, risk, and infrastructures. Today, I'm very pleased to share the spotlight with Duncan Trenholme, a global co-head of digital asset at TP ICAP. Duncan, it's great to have you on Clearing Spotlight. How are things on your side today?
Great to be here, Eric. Well, great. We had an amazing day at the LTP event yesterday.
Yep.
Congratulations all round on running a cracking event, Liquidity. So yeah, very pleased to be here in Hong Kong.
Thanks very much. I was in the meeting. I was in the panel yesterday. I saw you, and it was a great success. And thanks for sharing the insights with us yesterday. Okay, all right. Now, Duncan, could you tell us a little bit more about yourself, your roles in the TP ICAP, and give us an introduction of the digital assets and the business that you're currently actively in on.
Absolutely. So I've been at TP ICAP my entire career.
Okay.
Originally under the brand ICAP. It's like a lot of financial intermediaries. We've gone through quite a few sort of consolidations.
Yeah.
Growing with other companies and buying other companies. I spent 12 years as a equity derivatives broker.
Sure.
So on a broking trading floor.
The traditional.
Yeah, exactly.
Yep.
Working prices between different investment banks,
Yeah.
some hedge funds, asset managers. And in 2017, if you remember when Bitcoin was going to 20K for the first time,
Yes.
there was a lot of interest across the trading floor.
Yep.
I came across the Bitcoin white paper.
Right.
Definitely saw something in it.
Okay.
I studied physics when I was at university, so
Yeah.
and thought this is the sort of thing that I think is going to have real application across global finance. So we sent a couple of messages to our COO, asked him about what his thoughts were on crypto blockchain. What rolled forward from then was a working group. A lot of financial firms put working groups around crypto back in 2018.
Yep.
And from there, we built out a business. So I've spent the last 6 years working in crypto from a TradFi lens.
Yep.
For those that don't know, by the way, TP ICAP's one of the top 5 liquidity venues in the world. We're the world's biggest interdealer broker.
Yeah.
We've got 5,500 people in the company.
Wow.
On the London Stock Exchange. And generally, we are a venue where the world's financial, energy, and commodities products trade.
Sure.
So yeah, now we've been in crypto for the last 6 years.
Yep. So, given the congratulations to the move into the cryptos, and given the TradFi experience that you mentioned before, that I would like to start the questions with you that from the TradFi area. Predominantly would be market structures and the wholesale crypto markets, right? So what do wholesale markets in TradFi look like, and how close the crypto markets to functioning like this?
So I would say crypto is on its way to becoming a wholesale market. I mean, I would define wholesale markets as where business to business trading, usually global and cross-border,
Yeah.
typically in major financial centers. What is a wholesale market is the ability for banks or hedge funds or asset managers or commodities firms to transact in large size,
Yeah.
to exchange risk and hedge themselves,
Yeah.
and generally for capital to flow around the world and get from capital allocators to people that need to utilize capital.
Yeah.
What they're built on is, I mean, the big thing is standardization.
Hmm.
In order for large organizations to trade in size with each other,
Sure.
they need standards around how you trade, how you settle, what the rules of the game are.
Yeah.
And in truth, they're built on trust as well.
Yes.
In terms of
Absolutely.
institutions taking risk against each other. Crypto's on its way for sure. I think, like any new asset class, it evolves, and over time, different participants get together and form those standards.
Yeah.
I think global regulation coming in place is helping that. Here, while I've been in Hong Kong, we've been meeting different clients and participants, and to give a specific example, people are talking about when you're doing on-off ramp business in stablecoins. and you want to hedge yourself, everyone's managing different settlement times with everyone else in the market,
Yeah.
which becomes very operationally challenging for a business, because if you're settling at this time with one counterpart but a different time with another counterpart, it becomes quite a challenge. So standards would be something like introducing, hey, there's a Asia settlement time, there's a European settlement time, there's a US settlement time. Everyone can settle in that window. Everyone knows when that's happening. And what that does is it builds confidence in the market, and then volumes grow off the back of that.
Stablecoin then definitely is a big topic. It's an interesting topic. So let's we will come back to that point a little bit later. We'll circle that point. But I want to drag you back to the wholesale segment. Obviously, when we're talking about the wholesale, we're talking about the larger trade, and then we're talking about the market impact, so to speak, right? So does the cryptocurrency deliver real price discovery, or is it the liquidity still too fragmented to you from your perspective?
I think the short answer would be it's still very fragmented.
Right. Okay.
I think there's typically, as a market matures, you get consolidation. And you'll end up with liquidity coalescing in certain places. I'd probably say it's a lot less fragmented than it was previously. But yeah, I still think crypto is quite fragmented across, whether that be spot, derivatives, sort of borrow, lend, repo. There's still work to be done on where that liquidity is going to really exist on.
So from TP ICAP, what role does you guys play in this market in terms of the the fragments and the wholesale markets? Tell me more about that.
I would say specifically we have two current product areas. One, we provide liquidity price discovery services on crypto derivatives.
Sure.
So we help our clients, who are banks, asset managers, hedge funds, some of the big crypto native organizations.
Family office, perhaps?
Not so much yet.
Okay.
But some commodities firms, etc.
Sure.
When they want to get exposure to crypto derivatives, so price an option, roll their futures position, they can come to our team, our broking team, who know the market, know a lot of different participants. And what a firm like TP ICAP does is it protects you from a sort of information leakage perspective. So if you're looking to do something in the wholesale market, if all your counterparts know what you're trying to do,
of course,
the price tends to move against you.
Yes.
So coming to a broker gives you the ability to work that subtly. Also, in markets that are very time consuming and very fast paced, going out and talking to 2 or 3 counterparts is probably possible. But when it becomes 10 to 12 to 15 counterparts, it's much easier to go to one person who knows the best price across those.
Absolutely.
So that's a very traditional financial business model. Very high touch, white glove type of service. Then we've got on the other side of our business a spot exchange, fully electronic. It looks more like probably what people are used to in crypto. But where we differentiate a little bit there is it's operated by TP ICAP.
I see.
We're a publicly traded company. We have quite a few different regulated venues. So there's clear rules of the roads. You sign up to a rule book, and we bring some of the standards that we operate in wholesale markets to this crypto venue.
What sort of a percentage you would describe it as, like a 50-50 or?
Across those two businesses, probably more weighted around the broking side, because we launched that earlier. So we started that we actually crossed our first Bitcoin future in August 2019.
Okay.
And then launched the business fully at the start of 2020.
Right.
Whereas our spot exchange launched in October 23. So it's just a few years behind in terms of its evolution. But that's because it was a much bigger lift. Because you build the exchange, the technology, we got the FCA registration in the UK.
Right.
Electronic products, as I'm sure you know, at LTP are often harder to build the traction on, but they become very sticky.
Yes. We're building it, and we're getting there.
Yeah.
Now, when we're talking about the wholesale markets, obviously there's one questions that we were all facing. It's the counterparty risk, right? So the counterparty risk, and also most importantly, trust, as you mentioned before. Now, since you joined, the crypto area, the crypto world in 2018, if my memory is correct, what does counterparty risk really sit in crypto today, from your perspective, and how has it changed since 2022?
That's a very good question. So counterparty risk, I think, was very around the exchanges in the early stages of crypto.
Yeah.
There was a lot of bilateral risk, firms dealing with each other.
Mhm.
Solutions for managing counterparty risk is something that traditional finance does pretty well. It's just had longer to evolve through different failures.
We came in a long way. We came in a long way. Yes.
Yeah. Traditional finance has gone through blow ups and produced solutions off the back of it. Crypto's gone through a few, and even in the time that I've been in the market. So I would say we've obviously got 2 or 3 years ago, different primes started to evolve,
Right.
yourselves included.
Yeah.
Growing businesses that, provide that counterparty risk mitigation to underlying clients.
Yeah.
We've seen, I don't think many are live, but there's projects building out clearing houses in crypto. These are all things that are bread and butter in traditional finance.
Yeah.
So, and then on our side, we've recently launched a new product where we come into the market on our spot exchange and become principal to everyone's trades.
Sure.
So that means we are the buyer to every seller, and we're the seller to every buyer. And we take on that credit risk of everyone that's dealing on our market. So there's solutions like that coming from ourselves. But yeah, it's definitely an area that the crypto needs to improve on, I think, in order to bring in the major financial firms that are out there and grow the market.
That's very interesting. Tell me more about the clearing models, and what's your thought about that? Do we move to like the centralized, clearing models, or do we still on the bilateral, the relationships?
Well, one actually interesting thing to bring up is when in the early days of us exploring our digital asset business, one of the things that I heard a lot across the market and certainly resonated with our senior management was the idea that with blockchain, you could have real-time settlement. So instead of managing that risk, you can, because it's cheap and much easier on a blockchain to send assets from one place to another, that you could actually settle your trades immediately. What's interesting is when you talk to clients, they don't want to settle trades immediately, right? It's very capital inefficient.
It is.
How often, think about that from a treasury standpoint, you need to have all the assets that you want to trade immediately available to settle. So just like traditional finance, clients want capital efficiency. Sure. They want to post-trade settle, and they want to be able to trade under some form of credit exposure. So our solution that we've recently launched is, the specifics are, it's a very like net exposure limit. We say we do a credit risk assessment of everyone that's trading on our market.
Yeah.
We get our credit risk team comfortable with who the business is, where they're located, what their balance sheet looks like. And then we say up to this amount, we're comfortable with you trading with us, and we mark to market that in real time.
I see.
We look at all the different positions they have with us, and then once a day we call for the settlement. So what's called riskless principal, match principal, that's the kind of model. It's very common across traditional markets. It's something
it is.
Yeah, it is. We run it in our securities business. So it's really like evolving that and bringing it into crypto.
Yeah. So, in terms of these models, am I right to say that you will taking the holistic view on different clients' profile, based on their credit rating, the balance sheets, etc.
Exactly.
And then in that case, you probably will give a different credit line to different clients.
Yeah. We also look at whether the clients trade with us in other asset classes as well.
Okay.
You look at the sort of holistic parent risk against that counterparty, whether they're trading with you in equities or FX, etc. So,
okay, interesting. You're absolutely right. It sounds very much similar, if not the same, as the traditional market we're doing.
Yeah, exactly. And I think, one thing we hear from our traditional clients that aren't yet in crypto is they're very still worried about counterparty risk, because when you spend a lot of time optimizing your trading strategies, looking at finessing how you're going to generate P&L,
Yeah.
credit events can obliterate your returns. So you have to, and it's also, an existential risk to your business. So I think managing that and being able to deal against counterparties that you trust and feel like that's mitigated is really important. And one of the things that TP ICAP can bring to the market is, we're over 100 years old. We have a investment grade credit rating, and we can sort of bring some of that trust into the crypto market and stablecoin market.
So what does the market, so since you mentioned about the trust, right? So what does the market need to establish the, standardized trust? For example, things like private listed firms, investment grade credit, Yeah.
So I don't think there's one silver bullet to making crypto into and stablecoin markets into a wholesale market. I think quite a few of the things that are required are in flux. From the perspective of the client base that we talk to, many need clear regulations in place, and they need it in major financial jurisdictions that they deal other asset classes, where they deal other asset classes. So, there's a tapestry of different regulations on stablecoins, on crypto, that's coming into force across Hong Kong, Singapore, in Europe with MiCA, in the US. As those come in, that's a key unlock for a lot of firms. I think that standardized rules, like we've talked about, market standards, often it takes intermediaries, whether that be exchanges, brokers, people who have a slightly neutral view on the market. They aren't a trading client, to actually define those standards.
Yep.
And then actually a lot of the time is access routes into the market. So when we talk to our clients, they have, from traditional finance, their routes into markets. So that's EMSs, OMSs.
Yeah.
The idea typically for them of doing 95% of their flow in one way, but then adding on a new asset class and doing it in a slightly different way, is actually quite a challenge for them, because it's expensive, it's new operational setup, and doing that for just a very small part of your overall portfolio is often hard to get signed off. So where crypto providers partner with traditional finance providers, they'll sync. Big traditional EMS integrates with a crypto EMS. Crypto custodian integrates with a traditional custodian. That really increases the speed to market for traditional financial firms. And I'm expecting lots more sort of M&A type partnerships to come in the next 18 months between crypto and traditional firms for that reason.
Excellent. So we talk about market structure. We cover about the the counterparty risk and trust. Let's move to something that more interesting: capital efficiencies and credits. Why the capital is still so efficient, in crypto market compared to the TradFi? Given you obviously you got decades of experience in TradFi, but you also have a lot of experience in the crypto. What's your take?
What we've observed is actually using blockchain technology and settling on public blockchains like Ethereum, Solana, etc. You should be able to get better capital efficiency than you do in traditional markets, because typically moving money or assets is, T2, T1.
T0, perhaps.
Yeah, T0 is often an operational challenge. But there is a lot of trapped capital in traditional financial markets, whether that's in different exchanges, different PBs, across your business in different regions. The velocity of that money is limited by the infrastructure that we use in traditional finance, which is largely 20 plus years old. The plumbing that is being built around public blockchains should and is beginning to enable that capital to have a much higher velocity. And that is one of the reasons that a lot of like investment banks are getting excited about this technology, because being able to free up that capital, think your treasurer being able to take money out of one exchange and put it to another exchange due to a margin call, and being able to do that in minutes rather than having to go down to Swift,
exactly.
get it.
Yeah.
And freeing up that capital will mean that there's more capital available to put to use, to trade, to generate yield on, to, you know, drive more revenue in the business. So yeah, when a system like crypto grows from the ground up, it takes a while for those standards to be in place. But what we should be aspiring to as an industry is delivering better capital efficiency than we do in traditional markets. And that's going to be one of the reasons why crypto stablecoins using blockchain technology can really transform finance from the inside.
So tell me, who ultimately becomes the main credit intermediary? The bank, the crypto native firm, or protocols?
So I think one of the key things to be a credit intermediary is balance sheet.
Sure.
And from your time in traditional finance, who do we think has the biggest balance sheets? It's probably
The banks.
the banks.
basically,
Yeah. So I think they have an advantage, but I do think that what crypto firms
Yeah.
have is they are very fast moving. They're able to build their technology very quickly, and they understand the blockchain based markets, crypto markets, stablecoin markets. So they've got the operational expertise, the
Yes.
tech expertise
Yeah.
to do that intermediation. So in truth, I think we're going to end up seeing M&A activity between firms that have balance sheet and firms that have the operational stack to provide that intermediation. So those are the firms I think that are going to provide those type of services to the market. But you need the product to work well, and that's where the technology comes in, and you need the trust that it's going to be there consistently, and that's where the balance sheet comes in.
So who needs more help? Is it the bank need more help from or the other way around? In your opinion?
I think that's changed at different points in the market's evolution. So
Mhm.
in bear markets, I think banks understand that they can bring that trust and that the size and the breadth and their scale to the market.
Sure.
I think there have been points in crypto's history where we've been in very bull markets. Crypto firms have been rapidly scaling very fast.
Yeah.
A lot of the market has got excited behind them, like their valuations have, hit eye-watering levels. And there's probably been some expectation from those firms that they can come into the market and maybe replace traditional financial firms.
Yeah.
I think the truth is somewhere in the middle, right? I think there's going to be, like we've probably seen in other asset classes evolving, it's partnerships.
It's a partnership. It's equal.
Yeah. Where this really scales. So
Yeah, absolutely. All right, excellent. Thanks. Match principle. Let's come to that point. So what does match principle mean in traditional markets according to, again, your experience?
yeah, so matched principle, riskless principle is a model where you have a firm intermediate between trades. So the firm matches a buyer and a seller, and then steps in as that credit intermediation. And what they're solving is things like Hirschstat risk, where I deliver to my counterpart goes under and doesn't deliver to me.
Yeah.
So having someone to intermediate
Yeah.
ensures it reduces your settlement risk, that you are going to get the opposite side of the trade.
Yeah.
And it also manages that credit risk, i.e. that your counterparty isn't going to be there by the time you actually go to settle, because there's a difference between the trade time and the settlement time, and that's when your risk exists. So yeah, it's a very common, established, understood model in traditional finance. We run it in our securities business. We have, very large amounts settling through us on a daily basis, with large investment banks, asset managers. And I think this model, bringing this to crypto, is going to allow a much wider range of participants to come into the market. And I think that will help the overall crypto and stablecoin market in growing.
It's definitely solving the crypto market, the challenges that we're facing in the crypto markets. In terms of, we all know, like, the BTC, Ethereum's under the spotlight. Everyone's just watching this. But apart from that, beyond this, where is the genuine, institutional demand,
Yeah.
emerge just apart from these two?
So the truth is, stablecoins and real world assets, RWAs. And I think that's because these are two products that get right to the core of what traditional financial firms do. Stablecoins is evolving and disintermediating the FX market, and that is core business for most banks out there. And RWAs is hitting equities, it's going to hit credit, and these are big businesses for banks in general. So the crypto market, Bitcoin, Ether, and the long tail of crypto assets that have been out there, it's a new asset class.
It is.
It's grown, and but it doesn't challenge to some degree the existing core asset classes that financial firms are involved in. It complements them. It's another product. Bitcoin trades differently to gold. Ethereum is a different technology. It's a base protocol that allows you to send value around. It's different to what they deal with every day, right?
Yes.
However, when stablecoins come around and they start being pinged around the world and settling very quickly, that's really challenging the heart of an FX market. So I think that's why big financial institutions have dedicated so much resource to looking at these. Some people say that RWAs are essentially ETFs 2.0. It's that wrapper that allows you to put and package different products together. And instead of it going through a brokerage account and sitting in people's phones or on the internet on a website, it now sits in tokens that can be held in a digital wallet. It's probably got generational differences in terms of the end users who like that more than a brokerage account. There's probably a reason why lots of the big asset managers that are big on ETFs are getting early into tokenizing. Because it's distribution. It's a different audience that will be interested, but at heart, it's still financial products.
It is. So what determines which assets gain real traction? Is it because of is related to the liquidity or regulations?
So I would say it's actually client demand. I've observed over the 6 years that we've been in this market, it's been very supply driven, particularly on the tokenization side. So that means that you have a lot of tokenization firms, people that can create a real estate token or put private credit in a token. When you're supply driven, a lot of these projects haven't really scaled, and there's been a lot of critique from journalists out there saying, hey, the market's failed, it's not going to work. Actually, what we have found leads to commercial success, and actually building genuine product is when this is driven by client demand. So it solves a problem for a client, or they've got these financial institutions have clients that are saying, hey, unless you can offer this, we're going to go and start dealing with someone else, like a crypto brokerage or something like that. So I think it's client demand that is the most important thing.
It's great that we always have like the client demand or the business cases waiting there so that we can build, surrounding that to build the whole ecosystems.
Yeah, exactly. And I think a firm like yours at LTP, the client demand has come from crypto to start with, but what you've built out as a product for them, as those clients grow with you, they're going to increasingly want to do other financial products as well. So, and then it's that type of client demand that might lead them into, okay, now, instead of doing crypto, we want to hold stable coins and we want to hold gold as a token, and we want the whole investment universe to go through your pipes. So
we do see the increasing client demands or I should say the integrations between the TradFi and the crypto. Like you said, apart from that, we are looking to like a multi-asset offering as well. So that will be the interesting topic. Obviously, gold is one of the interesting topic lately, alongside with gold, BTC.
Asset classes become more topical and more visible across the market when they when they go through huge peaks. Yeah, it's huge demand, and we've obviously gone when we're recording this, gold and silver have gone through massive spikes and massive demand, so it's a hot topic across the market. And I think off the back of that, we've heard people having renewed interest in some of the gold tokens that are out there as well.
Now we finally come to the topic that it's one of the my favorite topic, which is stablecoin.
Yeah.
Are stablecoin becoming core financial infrastructures rather than just trading tools, from your opinion?
My short answer would be not yet.
Okay.
But I think they have the promise to be. So I still think they're a very small percentage of FX and payments transactions, but they're rapidly growing. I think they have the promise to become a core financial product. I think they're taking hold in markets where, in particular, they have not the same access to financial rails that you do in some of the big financial centers in the world. They've shown huge utility in cross-border payments and remittances.
Sure.
And I think you can conclude from the response we've seen from several major banks, financial intermediaries and exchanges at announcements around they're either looking at issuing their own stablecoin, they're partnering with stablecoin providers, that across the market people understand this is something you have to have a strategy around.
Obviously, where we're talking about the cross-payment, cross-border payments, and there's one thing that we can't avoid is the regulations, right? So how do regulations and also the interest rate reshape, the stablecoin economies, from your opinion?
Well, we have specific stablecoin regulation being worked on in major financial jurisdictions. So I've just left the UK, moved over to Singapore, but stablecoin regulation was a hot topic at home in the UK.
Yeah.
And I think the different jurisdictions are trying to get clear rules out on stablecoins to court the industry and ensure that businesses work onshore and build their businesses there.
Yes.
And there's a bit of competition, I would say, between different regulators in terms of trying to balance consumer protection, but also ensuring that they enable stablecoin businesses to build and grow. And obviously that's good for the economy in those regions and GDP of the country in general. So that's definitely a factor. In terms of, I think at the moment, because most stablecoins are US dollar denominated, I think it will be as we get more AUM in different other stable coins and we end up with a
euro.
Yeah. I mean, there are obviously coins and stable coins out there fairly different, but I think 99% of AUM is the US dollar stable coins at the moment. So as we end up with a bigger equivalent stable coins in different regions, I think we're going to end up seeing much more impact from interest rate markets on the way these stable coins trade against each other.
So is tokenization a technologies upgrades or fundamental markets shift from your point of view?
I think it's a fundamental transformation to the way that finance operates. So it was actually the thing that got me most excited when scroll back to 2017 when we were sat there on the ICAP floor thinking about how blockchain could impact finance. One of the things that I found bizarre is even in 2017, 2018, and I'm sure it's the case now across finance, at the amount of manual processes that exist. Like, I'll give you an anecdotal example. So even, I don't know if it was in 2017, but even in 2016, people were running from one floor to another with paper tickets for futures that were executed and giving them to like, hey, here's this ticket. Can you note down?
You need to do a timestamp before that.
A little thing that you actually, it got done at this time. It's crazy.
Yeah.
And I was still in operation. So like, if you think that there's that, and then, there's email confirmations, there's the amount of times that we'd end up with like equity settlement where it's like Counterparty would say, hey, was that priced at 129 spot 18?
Yeah.
Like, no, it was 129 spot 17.
Check the tape.
Yeah, check the tape. And then it would like, the trade wouldn't fail.
Yeah.
The trade would fail. It wouldn't settle till the next day.
Yeah.
And someone would get charged interest on it. And it's like, it's just inefficient. Right.
Yeah.
So the sitting there and thinking, oh, you're going to have blockchain-based asset with smart contracts that can mitigate some of these issues. Everything will be automated. It will reconcile. It will transfer much quickly. It's like, oh, okay, if we can do that, if we can share this universal ledger that everyone is plugged into and everyone can trust as the record of truth, rather than everyone having centralized databases and always trying to reconcile between each other manually. Like that promise, I think, is something worth striving for. So we said to our management at the time, look, for every dollar invested in building towards this future, you're going to get a much higher ROI than trying to catch up when something that, I don't know, you're number 3 in or 4 in and you're trying to raise to second or first. And it's when markets get very competitive like that, you got to invest a lot of dollar to move up. So we said, look, it's worth investing in building towards this, crypto capital markets, blockchain-based financial markets, however you want to describe it. And I think we've always thought that crypto is the gateway to this product, the Trojan horse, if you want to describe it like that. Okay. And that comes back to my point earlier about client demand, because there's been a lot of projects in the financial industry to get consortiums together, use a private DLT, let's take the bond market, let's move it on chain. It's been hard, it's not impossible, but it's been hard to get a top-down consortium of firms together to move their operational stack to something different, because there's big capital expenditure around that. You got to invest a lot. You need everyone in the market to do it with you, and then maybe you realize some benefits of this new technology that you're working on. What we've actually observed happen is every peak and trough of the crypto market, a new wave of financial firms, of businesses out there have come to the crypto market, and some have gone and most have stayed. And when they've done that, they've set up with firms that provide custody. They come to prime brokers like LTP. They've plugged into the system in some way. And what we're finding is that once they do that and have access to crypto, and they're like, well, we can also store a gold token and trade it here. And now we've got Biddle and Benji, which are money market funds. And suddenly they'll be like, well, this system is just way more efficient than what we used to. So I think it's a creep. It's not overnight. We think it's going to take, maybe we're 6 years into a decade-long transition. But I think over time, it will be a little bit like the way electronic markets spread throughout finance. I think FX was quite early because it's one standardized product, treasuries as well. But that's gradually spread through finance because trading electronically is much more efficient in general.
So, Duncan, last questions for you. What actually unlocked liquidity in tokenization markets? And it's because of the regulations, distributions, or technologies rather?
Oof, that's a tough one. Do you know what? I think that is the answer that my CEO would like to have. And you know what? I'm not sure I have it, because if I did, we'd be able to very well position our digital assets business around which asset class we should go for first. I genuinely think it's the $1 million question in the digital asset market, the blockchain market, is how I think everyone understands that this is the direction we're traveling in. This is the North Star. This is where we want to end up in terms of the world's financial, energy, commodities markets moving around on chain. I think the real answer is there's a lot of great companies, a lot of great businesses out there pushing in different directions and trying different tokens, seeing if they get product market fit. And I think it's going to take the whole industry to push into different directions. Stablecoins are one, but to get that consumer interest, pique the interest of clients, and really sort of build a business around tokenization. Sadly, I don't think there's a fast track to that future.
Okay. Thank you very much. Thanks for your time, Duncan. And I hope you enjoy your time staying in Hong Kong. And I hope you enjoy the time with LTP.
Absolute pleasure being here. Thanks, Eric.
Thank you.